Hi guys and welcome to another episode of the TFS Wealthcast. And today's episode we're going to be focusing on the new budget which was just released a few days ago. And we're going to talk about why this budget matters, what changed, the three big tax changes which are negative gearing, your CGT, and of course trusts. And we're going to talk about the winners and the losers, the ones who benefit and the ones who are going to be paying more. And to go through all this, joining me today is none other than one of our founders and COO, Miss Sonali. Mrs. Sonali.
Miss Sonali.
Hi Sonali, how
Hi.
are you?
Hi, good.
It's an exciting topic, Sonali. Huh?
Very interesting, yes, okay. Dry, yes, but let's get into it.
So before we begin, I'm pretty sure a lot of people are doing podcasts and videos about this and content based on this. But before this budget came out, what were your expectations? Were you expecting it to turn out the way it did, or did it surprise you?
No, it was a bit surprising because one of the things that Labour had promised was they wouldn't touch negative gearing. So it was completely, it was a complete backflip. So that was a bit surprising. But a couple of days before the budget, obviously you hear whispers. So we got to know, and still surprised at some of them.
I mean, there was a lot of speculation around the whole negative gearing and CGT.
But it's a massive overhaul, and I'm interested to see how this turns out. Yeah.
I think one of the biggest surprises were that they got rid of negative gearing and then the CTG tax discount, right? But they also started taxing shares and other investments.
Yeah, I think it was more. Yeah, you're right. So if they were trying to really sort of manipulate the property market, they could have isolated that and left the other ones out, the other asset classes out. But no, they did a blanket approach to it. So looks a bit of a tax gouge as well to me. But
government just trying to cover their losses.
Spend more in other areas, basically. Yeah.
All right, so let's dive straight into it, right? Let's talk about the three big tax changes. And like you mentioned, negative gearing was one of the biggest. So what is negative gearing, Sonali, in simple terms?
So negative gearing, obviously you will hear this term thrown about quite a bit when we talk about property investment. Simply put, when you have a rental property, you get rental income and there are expenses associated with it. So expenses such as interest expenses, insurance, you pay a property manager a management fee to manage the property for you. There might be rates, council rates, there might be water rates, things like that, right? So when you look at the overall picture, how much income is coming in, how much expenses are going out, if you're making a loss, that is called a property is negatively geared, basically. Now, under the old rules, that loss, you could offset it against your salary income, or if you were self-employed, your self-employed income, thereby reducing your overall taxable income. But moving forward, they have scrapped that, so you're no longer able to negatively gear or use that loss to offset against your salary or self-employed income if the loss is created by an established property. You can still do it for newly built properties, but you just can't do it if it was an established property. Now, the date on which, the actual date that matters is obviously 12th of May, 7:30, they say. I don't know the significance of the time. Maybe they check the time that you sign your contract, which in this day and age you can. So you could probably argue that if you signed at 5 o'clock before it was announced, you qualify as an established.
But then in that case, the contracts have to be signed by both parties, right?
That's right. Yeah, to be executed.
So just because the customer signs and then...
No. So, I'm sure there must be some significance like that. Maybe a lawyer can shed some light on that. So if you owned a property, an established property, you're fine. It goes as a property that you already own, and thereby you are protected under the grandfathering rules. But if you buy a property, an established property after the 12th of May, you will no longer be able to use those negative losses against to offset your taxable income.
On that, Sonal, you mentioned the grandfathering rule, right? Can you elaborate a bit more on what this term is?
So simply put, say for myself, now I had a couple of established properties that I owned before 12th of May. I
Yeah.
had already exchanged contracts, and even if it's not settled, they go by the date that you exchange the contracts. So you might settle, say, in June, July. That's still fine. It's the contract date. So if you already owned a property on that date, you are fine. You can use the existing rules, which are to be able to offset the negative gearing losses against your taxable income.
Yeah.
But so grandfathering essentially means you can make use of the existing rules. Even though the rules change moving forward, you're protected until you sell that property, basically.
Okay, so basically, customers, investors who purchase property before this, they're
They're
safe.
fine.
Yeah,
They're
it's
safe.
anyone who's thinking of buying
Yeah.
established investment properties now that has to
That's
really.
right. That has to really think about. Especially, there are some of our clients as well who are in like a really tricky period where they've got approval from the bank for a certain amount, but they're out there looking for established investment properties. Now, we've spoken to all our clients who are in that position, because moving forward, we don't really know what the banks are going to look at. None of this is set in stone yet. It's not legislated yet.
Yeah.
So therefore, it's a tricky period where no one is really sure if the banks are going to turn around and be like, okay, you no longer qualify for negative gearing. We have taken negative gearing in your borrowing capacity calculations and approved you for this loan. We can no longer give you that loan. So you have to be very careful if you are signing something to sign it subject to finance, so that we can then go to the bank and get formal approval so that you know that you're in the clear. So if anyone's out there buying established investment properties, please make sure you sign your contract subject to
So
finance.
in that case, since they've taken off negative gearing on established properties, how does this affect potentially affect the borrowing?
It goes down.
Goes down.
So yes, so all of the banks, when they look at your servicing capacity, they take into account the benefit of this negative gearing, reducing your taxable income. Thereby, you pay less tax, thereby having more discretionary spending to spend towards the loan repayment. That's how they look at it. So when negative gearing is taken off, your discretionary income that you have towards loan repayments will reduce. Therefore, they will give you a lower loan. So,
And this is only for investment loans or own occupied as well?
No, own occupiers they're fine, because you're going to live in it. So there wasn't any tax benefit taken into account in those calculations. It's only for the investment clients. Also, only for the investment clients buying an established property. So if you're thinking of buying a brand new property, a house and land, no impact on you. You still have negative gearing benefits available. We still don't have direction from the banks exactly how they're going to look at this servicing. They'll probably release new serviceability calculators with all of this incorporated once it's legislated. But we're still in that tricky period where it was announced, but not a lot of the nitty-gritty is known yet, basically.
So we won't know for sure until the banks come out with the updated policies, right?
Yes, correct. But the banks can't come out with it because it's not legislated, and maybe things can change. So this is as at what was announced on the 12th, basically.
Judging by the public's reaction, I think this government is definitely going to change.
I get to vote in the next election, so I'll go cast my vote.
So that's negative gearing. Now, let's go to the other big bad, capital gains tax.
Oh, I'm still very interested to see how they're going to administer this, because it's very complicated, and they've also taken into account pre-85 assets, which largely were exempt for a long period of time. Most people can't find paperwork from things that happened last week. So try finding paperwork from things that happened 40 years ago. Good luck with that. So
and that's why you need a financial planner.
Well, personally, I'm not great with paperwork either. I don't I keep things for about 7-8 years, but that's it. Like 20 years even. It's anyway.
So now, how does CGT work now?
So at the moment, if you have an asset and you own that asset for more than 12 months and you sell it after 12 months or have owned it for 12 months, any gain that you make on that, you get an immediate 50% discount on that gain, and that gain is then added to your taxable income. and you're taxed at your marginal tax rate, so no, your normal tax rates.
Yeah.
So let's say you made a gain of $100,000. You have had that asset for more than 12 months. Only 50,000 of that will be added towards your taxable income, and you would be taxed as normal.
Okay.
So typically, we do quite a bit of tax planning around this because it gets added to your taxable income most of the time with with planning and all of that. We kind of tell clients, okay, maybe we should get rid of this asset in a year where you don't have a lot of taxable income, so that in a year that you have a lot of taxable income, you don't want to add more into it
Yeah.
and pay more tax. So maybe let's time it so that you get rid of this asset in a year where you know that you're not going to have as much,
Yeah.
thereby paying less tax. So there was a lot of planning opportunities around that when we could do that. But now with the new rules, they have scrapped the 50% discount.
They've
They've
reduced
brought
it.
in an indexation option. Again, not a lot of information is there around indexation. All we know is that they'll take the cost base and index it. I don't know by how much. I don't know the mechanism behind it because it's not very clear yet.
Yeah.
And then you pay tax on the gain. However, they also have introduced a minimum 30% tax rate on that,
Okay.
which sucks really. So, for want of a better word, because there's then the planning stuff that we have already done. We now have to go and revisit all
Redo
of
it.
that
Yeah.
as well. And then moving forward, it's going to be very difficult to sort of how to get rid of certain assets. When do we dispose of them? Because it's one of those things where especially with investment properties, we talk about accumulating, but we also talk about how do we then divest and get rid of them when we are retiring, so that they can then fund our retirement. That's usually the plan, right? So all of this will mean that we now need to go and revisit all of that and see how best to sort of structure them. But again, look, if someone's smart about these things, there's always ways to do things and still achieve your goals.
Yeah.
But there's a lot of work that needs to be done then.
Yeah, and then also people need to educate themselves as well.
That's
now,
right.
More than
Yeah.
ever, yeah.
So as opposed to making things easier at tax time, this would add another layer of complexity for the client. So there's no way now that a lot of people can do their own taxes. They'll have to hire an accountant to do it
and
for
and,
them.
and that too, an experienced accountant, right?
Yes, because there's so many things. And with the CGT, the funny thing is, like with negative gearing, existing clients were exempt, grandfathered, so they were fine. But then with the CGT changes, they've got a cutoff date. And then from that date, 1st of July 2027, up until then, you have the 50% discount. But any gains from that day onwards is treated with the new treatment. Okay. So you have a mix of treatments then for one asset then. And then on the 1st of July, you need to know what the value of your asset is as well. So there are a lot of layers then that you'll have to go through and be mindful of as well if you are then holding assets. If you do something before that or sell before that, then you still have the old rules basically. Okay. But if you go past that 1st of July 2027 date, then you'll have essentially two treatments for the same asset. So it's a bit complicated, to be honest.
So as an investor, are you planning on selling any properties in your portfolio?
I might sell, we might sell one or two, but again, you don't want to sell a lot during 1 year as well, because then you'll increase your taxable income. So you have to be smart about how you do it. And then also, because we've got in certain structures, I need to then revisit all of that and see what's the best option. So there's going to be quite a bit of planning needed for a lot of people. Yeah.
So as an investor, as a property investor yourself, do you look at yourself investing more in brand new builds now, or are you gonna?
I have always invested more in brand new builds. Obviously, it comes with the territory. We get access to quite a bit of that. So we've invested quite a bit in brand new builds. So I don't think that will change anyway. So then I don't think.
But even with all these new changes, your view on brand new builds stays
the same. It is, because that just suited us for a variety of reasons. We like building as well, so that wouldn't change personally for us.
Yeah.
Yeah.
So Now, one thing that I've seen with most of the builders we work with, they've amped up their marketing on new builds of the plan, right? So, what do you see for the future demand of brand new builds? Of course, given the current context, I see demand going up, right? So, how would this affect the market now? Because one of the whole points of this new budget was to make it easier for first home buyers to get into the market.
Um, Look, obviously, when demand goes up, the prices will
Go
end
up,
up going
exactly.
up. So, most likely, the developers would put the prices up quite quickly.
Yeah.
So, affordability will then become a
It's
problem
really not making it easier for first home
again.
buyers,
So,
right? So,
yeah. But then, look, what I think the government was trying to do was modify investor behavior with this, right? So, to try and reduce the competition in the established market by making it less attractive for investors to be in that space, thereby reducing competition there and demand there, so that hopefully the first home buyers could get in and buy an established property. With the new builds, their thing is, okay, if it increases the housing supply, then again, that helps with the pricing. So that's where they were going with it. But yeah, it remains to be seen whether that'll fix what they thought would fix, or whether we see less investors having less houses available for rent, and therefore having an
increasing
unintended impact on the rental market.
Yeah.
Because now all of a sudden investors can't be bothered to put properties out for rent, and therefore there's more demand for the existing properties, thereby driving the rents up. So while helping the first home buyers, the government may have unintendedly kind of
Just shot a whole other demographic of people in the market, right?
But then also there's probably a lot more renters than there are people looking to buy.
Their first home,
yeah, let's see how this goes.
And with another rate announcement in June,
Yes.
most likely to go up.
Yeah, so you're getting hit on all fronts, really. So yeah.
All right, Sonali. So the third element we're going to talk about on the three big tax changes, right, is the change to trusts, right?
Not a lot of people are talking about it. I think
Exactly.
everywhere I've seen all the property gurus and all
negative
everyone.
gearing and capital gains.
That's all
that. Yeah, that's all they're screaming about.
Yes, on social media. So this trust, so discretion. I think there's about 1 million discretionary trusts in Australia at the moment. It's almost like the favored vehicle for small business owners. You go to an accountant, you operate as a sole trader, and then when you're doing reasonably well, you get told to do a trust, basically. The reason is because you have the discretion on how to distribute the income, so that if you earn a reasonable profit in the trust, and then you have family groups or whatever, you can distribute to the family members, yourself, and all of that, and do a bit of tax planning around it. You had the discretion, and there was no set rule where if you distributed a certain way one year, you had to do the same way the next year. So depending on the individual's incomes, you can make changes. So you had a lot of flexibility with this structure, right?
Okay.
But now they're looking to change that. They're looking to introduce a flat 30% tax rate in the entity itself.
Okay.
Which means it's almost like, another option accountants would suggest is to open a company. The reason why people don't open a company as opposed to a trust is because there's a flat tax rate in a company, right?
Yeah.
So then a lot of people would prefer to have the flexibility to be able to distribute income. So with this one, if they introduce a flat 30%, then it's almost like, okay, then do I do a company then? Because that rate is probably less than that for smaller businesses. So there's going to be a lot of questions asked around that, and a lot of small businesses are going to be impacted. So I think people would really need to have a look at their structures, have a chat with their accountants. Now, this is, I think, from what I read, getting into effect from 1st of July 2028. So there's a little bit of time for you to do a bit of planning to see if you should change structures or what you should do. But certainly something, again, that will have quite a bit of an impact on the small business owners. So I'm not entirely sure who that's meant to help, actually, but except the government. But yeah,
So
yeah.
small business owners, I mean, even though you have till 2028, you need to speak to a financial planner that can
More
help you.
well for this one, to be honest, mostly an accountant
Okay.
because it's related to how they run the business and what plans they have for the
Yeah.
business. Should they move to a company structure? Should they move to a fixed trust? Or I don't know. So yeah, it's something that you definitely should look at.
Awesome. So, guys, there you go. Those are the three biggest tax changes that we're focusing on. And now we're going to talk about the winners and the losers from this new budget. Uh, so, some winners, right, are workers because more than 13 million workers will receive a $250 working Australian tax offset
Yay.
from, from 2027 to 2028. Yeah, $250, Sonali. What do you think about this?
I think people would just go shopping with it and then they'll say, oh, yeah, we've got inflation and therefore we need to increase the rates. So, I don't know. It's neither here nor there. What are you going to do with
And the Prime
250?
Minister really emphasized a lot on the
250.
$250. I'm like, what?
So, yeah.
If you want a better deal, refinance with us and we have a
We
better
can get
cashback
I
offer.
know, right? And and you could probably save far more than 250,
Yeah. So also, so small plug here. If anyone is looking at refinancing and fixing their loan term on a 2-year fixed, for 2 years, we have a $2,000 cashback offer that we're running. So do contact us to find out more. Now the second winner, and this was the winner that had most of the emphasis on our first home buyers, because the government says housing tax changes are intended to support owner occupiers and could add around 75,000 additional homeowners over time. Now we did discuss a bit on this previously about a few minutes ago. But to speak on this again, because we do have a significant amount of first home buyer clients that we work with and help out. How are these clients affected now, Sonali? The ones who've already got their pre-approvals?
The ones who've already got their pre-approvals for an own-occupied property, they won't have too much of an impact other than the fact that, there might be some activity going on right now. If they're looking for a new property, those prices might go up. Developers stop. It's very easy to increase the price immediately, right?
Yeah.
So they might, find that that's gone up. But yeah, not too affected right now for the first home buyers or unoccupied lending. But it's the investors basically that really need to be mindful of the approval they have at hand before they go and buy something. Yeah.
But like we spoke, builders are definitely looking at increasing prices.
Yeah, for sure.
Right? So first home buyers who are still thinking and waving around.
They should probably get in before the builders get their act together.
Exactly. And another winner are new build investors and developers. New builds retain the most favorable tax settings and undertake get the most tax benefits from this new framework, right? So like we discussed, we are seeing builders going to increase prices.
Possibly,
But in terms of developments now, since you and Pramu, you guys are into your own developments as well, do you see this as an opportunity to?
There as well, Vishy, the guidance is not clear yet because I read in one report, new builds, you have to be careful what gets classified a new build. So you would assume a knockdown and you build a new house would get classified a new build. I did read somewhere that if you build one single house, then it's not classified a new build.
Okay.
You have to either have a duplex or an apartment or a set of apartments or a set of townhouses for it to be classified a new build if you do a knockdown rebuild. So again,
exactly.
we need proper guidance before we really talk about it because it's not very clear yet. So that remains to be seen. But obviously, straightforward new builds would be your house and land packages, brand new stock. And then I did also read what gets classified a new build. If someone has lived in there for 12 months or more, obviously it's not a new build. But if someone has lived in there for 12 months or less and then you sell it, the next person gets to classify it a new build. So who knows? These
Yeah.
might, once it's legislated, we will get all of the nitty gritty. So that's when we can really make a call on it. But yeah, it's here and there still. So, but so straightforward new builds for investors. Yes, you get to still maintain your negative gearing on that. So that's the easiest.
Another winner, right? Small businesses. The $20,000 instant asset write-off is being made permanent for eligible businesses. Now, previously we discussed the trust tax change that will affect small businesses. And then there is this incentive.
Make hay while the sun shines. So now this is permanent. So anyway, now with the end of financial year coming up, this is something small businesses make use of quite a bit. It was meant to be wound down, but they have decided to keep it as a permanent fixture. So 20,000, if you buy a car or equipment or what have you that is used in the business, you get to claim an instant write-off on it, as opposed to depreciating it over the life of the asset. You get to do it instantly in that year that you bought it. So lots of small businesses use that. And so if you haven't used it this year, you could probably have a little under 2 months to go do that.
So are we buying a new vehicle for the company?
No, we're not.
Come on. A nice Jeep Wrangler with the company logo. All right, so those are your winners, ladies and gentlemen. Now we're going to talk about the losers. Investors buying established residential property after the budget, they lose the traditional salary offset benefit for rental losses.
Yeah.
Right. We also have in the losers list, high income families using discretionary trusts. Trust taxation becomes less flexible from 2028, like you mentioned. Now, another loser in this category, Sonali, is EV buyers.
Well, I think that people flock to EVs because of the fuel crisis. So there were some fringe benefit tax concessions that they had, but those are being wound back. So yeah, I think previously now it's going to be about 25% or something. I didn't read the specifics around it, but yeah, they're going to be worse off. So yeah.
It's crazy. At one time, the government's trying to shove EV vehicles down everyone's
and now
throats.
they're incentivizing it. Yeah.
And the last but not least, investors relying on old established property models, right? Future deals become less tax effective than before.
Yeah, definitely. So previously, when we looked at the numbers for an investment property, we looked at before tax how much it will cost, the cash flow, and then after tax because of the negative gearing benefits of it. Whereas now we'll have to start looking at it a whole different way if people are buying established properties. So once it's all legislated and we know exactly what's going to happen, that's when we will start looking at our longer term clients and then see how it's going to work, because the next acquisitions that we had planned for them, how those will work and how we need to modify the plans basically. Yeah.
So I guess one of the bigger policy goals, one of the bigger goals from this policy was to change future investment behavior, not to, let's say, unwind the past, because existing investors are not the main target if they already held property before budget night.
Yeah, so it's more, like I said before, to modify future investment behavior to help, supposedly help the first home buyers. But I also feel like then they don't get to benefit from the wealth creation strategies that we used, So as much as they get into their first home, then they don't get the benefits of, all these things to build wealth for their future. But, they need to start at least getting one property. So I guess if this helps get them that, and then we'll have to figure out ways to, get them the next ones.
And I guess it all comes down to kind of re-strategizing as well, right?
Yeah,
in terms of
for sure.
Finances, now even lending, like instead of just going to a bank or broker and just getting a home loan, there are so many other fundamentals that need to be considered.
Yeah, it's a lot more nuanced now because even lending gets complicated because they will have to see like I was thinking, okay, if an existing client, an investor client with an established property wants to go from one bank to another, usually we are still able to use the negative gearing benefit. But then it's an established property. So then the banks are going to have to kind of figure out, okay, how do we, address each scenario? Because there's
Yeah.
going to be lots of scenarios now. People buying new property, people buying established property, older clients who had already bought established property who wants to refinance. How do you service each of them? So it's a lot of work for everyone
I feel
to.
like banks need to invest a bit in their training as well
Yeah,
now,
because
right?
so they'll have to come up with all these new calculators and policies,
Yeah.
and we might see a lot going on in the banking space as well.
What do you
So
think will happen to like the lodgement turnaround times?
it's just gonna blow out. So guess who's gonna copy it in our office? The front enders would speak to clients. So yeah,
Sorry, team, get ready.
yeah.
All right, Sonali, now there were so many other changes in this budget, right? But in terms of investments, if we look beyond property investments,
Hmm.
what do you think about the changes to?
That's a funny one, actually. So there are some clients who borrow to invest in shares,
Yeah.
and then you get to claim the interest on that. You still get to claim the interest on that.
Okay.
So we might see a redistribution and diversion into other asset classes that previously went to property, I think.
Yeah.
So because you still get to claim negative gear, not negative gearing, the interest
Yeah.
and the costs associated with earning that income from shares against that income. So, or your overall taxable income. So yeah. We'll
So
see.
what are some asset classes that look favorable to you now? Like
Well, shares always has been
Yeah.
one of the things, because obviously it gives you capital growth as well as dividend income, so you get the benefit of both types as a return. So yeah, shares, direct shares, exchange traded funds, managed funds probably a little bit less so, but still there's a place for that as well. So yeah, there's a lot of other asset classes other than property that can really get you to where you want to
Yeah.
be as well.
On the topic of other asset classes, now in terms of property, most of these changes affect residential property, right? But I didn't see anything about the commercial space.
No, I didn't see that either.
Yeah.
But a lot of the time, you'll see mom and dad investors, they don't straight away get into commercial property. They just dip their toe buying their first
Yeah.
home, then they buy their first investment property, and that's usually residential. It's probably your third, fourth, or maybe even later than that you go to commercial.
Commercial.
But yeah, maybe we might see a shift to that as well, because who knows, because that has more income anyway. Now there's not much benefit being negatively geared
Yeah.
anyway. So, yeah.
That's an interesting point.
That is an interesting
yeah.
point, actually, because a lot of the time, even most of the expenses your tenant pays, right? So, yeah, that
And
can be
also
something.
your lease agreements are much longer.
Much longer. That's
Right?
right. So you have more stability.
Yeah.
Rather than
And you don't have to worry about
tenants.
looking for a new tenant.
That's
you know.
right. Yeah.
Tenant's not going to leave every 3 to 6 months.
And it's a lot less, like, nowadays with tenancy, the landlords don't get too much rights, whereas with commercial, the landlords pretty much still rule the roost. So, yeah.
All right. So, I guess those are some of the main touch points, right? That we wanted to focus on. We focused on. Before we end this podcast, if we could look at touch a bit on like the future outlook from your perspective, Sonali. What do you think about inflation, the current inflation rate? And what do you think? Do you think this budget's going to help mitigate rising inflation, or
No, the budget is not going to, I don't think, do too much for the inflation. I think it's mostly the interest rates that will dictate that. I think it's still higher than what they want it to be, so there might be another rate rise on the horizon.
Yeah.
And then maybe after that, we might see a bit of an easing or staying stable. So, that's how I feel about, because I don't think these changes would like even for first home buyers, it's not going to fix affordability overnight, right? So you're still going to have investors who want to buy property, because previously, like I've always said, tax benefits should not be the main driver of a decision to buy investment property, right?
Yeah.
It should be like almost like a side benefit. You still need to look at capital growth, you still need to look at the rental income that's coming in. So those drivers haven't changed. So I feel like people would still, investors, cashed up investors would still go for established properties regardless of, these losses in negative. So because of that, I don't think it's going to be an overnight shift and immediate possibility for first home buyers to just go out there and buy for lower, right? But remains to be seen if it can help like 75,000 people get in. So yeah.
All right, Sonali, thank you so much for doing this podcast on such short notice. Right?
Yeah, I didn't have too much time to get my head around all these ones, but yeah.
Did you even were you able to finish reading the policy?
I didn't read the whole thing. I just read what I wanted to read and the summaries that we get given, because we get summaries for advisors where the areas that really impact our clients. So
So thank you guys so much for tuning in, and thank you, Sonali. Guys, overall message: don't react to headlines. Right? You need to model the actual numbers that work for your specific situation. So
I don't think that has changed actually. Every time that's what I usually sign off with, right? Don't panic about the headlines or what the markets are doing or what the outside noise is saying. You just need to do what's right for you and your circumstances. So this is probably now more so than ever. You need to really understand where you are, what you're planning to do, how you go about doing it. You need to watch your, cash buffers, improve cash flow where possible. Don't take on unnecessary debt. If you're buying established property, have a look at the numbers really well. It really needs to stack up now, because unlike previously where in the second year you might get, a bit of a tax refund or whatever, this time you might not. So therefore the numbers really need to work. So as long as you know your numbers, then it's all good.
And if you don't know your numbers and you want to speak to a team, a group of individuals that know how to run the numbers for your specific situation, you need to speak to TFS. Not anyone else, speak to TFS. And with that being said, guys, thank you so much for tuning in, and we'll catch you guys on the next episode.
Thanks, Vishy.